Hi, this is John Vance, and welcome to our 2025 Mid-Year Economic and Market Update. I'm John Vance, President and Founder of Vance Wealth. I am so pleased to be here with you today. This is one of my favorite topics to cover. We do an annual update and a mid-year update every year to provide insightful information around what's happening in the economy, what's happening with the markets, and it allows me to provide hopefully try to take all the noise that's out there between what you see in the media, what you're seeing online, what you're seeing in maybe print, like from the Wall Street Journal, and really disseminate it down to some information that can be helpful and useful. I've been doing these now for over 20 years. I get a lot of value out of it because I know some of our clients love getting into the weeds and understanding what's happening, want to get our perspective as a firm. And so that's why we're here today. So again, thanks for joining us. If you notice, we're streaming this through YouTube, so please subscribe to our channel. That will give you updates so that as we do these in the future, you'll be automatically receiving these. And then additionally, we'll likely have this set up in different chapters, and so this can be fairly long. My guess is it's going to be somewhere over an hour, but likely short of an hour and a half, where we're going to get into the weeds and have lots of things to cover. And we're going to break it down by different chapters. And so again, I hope you enjoy. And then please, if you have feedback for us, please let me know. And as we start getting ready to go into year end, if there are topics you definitely want us to cover in the future, let us know as a firm, because we can definitely accommodate that. So again, thanks for being here, and I hope you enjoy the content. Here are just some of the disclosures. I will go through that quickly, but if you want to read them, go ahead and pause on that. All right, so we're going to break this down and run through the economy, the markets, real estate. We're going to get into the tax bill. We're really going to cover a lot of issues. And so we're going to just dive right in. I do like to apologize ahead of time. It's like drinking through a fire hose. There's tons of information here, and the slides are going to tell a story. And so here we go. We're going to first cover economic updates. So this headline, one of the things that I recognize being an investor, being a client of our firm, is that we see a lot of headlines, and headlines, they're designed to sell papers. They're designed to get eyeballs on them. And oftentimes, people are making these predictions, and more times than not, they're wrong, right? And so the reality is, I think that's one of the hardest things being a successful investor, is you have to figure out what you're going to believe, what you're not going to believe, or you just take the approach, I'm going to be an investor. I'm going to be a long-term investor, and a lot of this economic data that I'm going to cover is just noise, because the economy is always moving. Economists all have different opinions, but I'm going to share with you some of the highlights of what's happening from an economic perspective. So if you all recall, within the last 2 years, we were seeing a lot of chatter around a looming recession. And now what you can see on this chart, this was in a Wall Street Journal article just a few days ago, that there's a bit more of a lower recession risk, and they're seeing more growth. And when we looked at actually the predictions, they were just dead wrong. The good news is now they're predicting that there's a lower recession risk. So hopefully they're right with this one. Then when you get into some of the data here, we're looking at GDP estimates. And you can see on this chart here, going through the actual GDP, which is in the black, and all the forecasts. And you can see the forecasts, if we look back to 23 and 24, were all too pessimistic. And from an actual perspective, we did much better. And it looks like as we come out into the second quarter, the data is going to improve. And then in the bottom right, we're looking at that the probability of recession over the next 12 months has really gone down. I guess unfortunately, with my background, I studied economics. The economists have to make predictions all the time, and I would say generally they're probably pessimistic is one thing, and then they're just wrong a lot. So I just wanted to share what's happening from a headline perspective. Now I'm going to share with you some of my thoughts as we look through the data. So from a long-term perspective, we look at economic growth, and we look at what the composition of GDP, or gross domestic product, is. This is a chart that goes back to 2000 roughly, and it just shows that we've had this long-term trend of GDP, real GDP growth, meaning adjusted for inflation, and we're looking at like a 2%, which is fairly low, actually. We would like to see this real GDP be a lot stronger, but the reality is this is our long-term trend line. And when you look at where all the components come from, we do know America is very much a consumption-based economy. You can see that on the right-hand side, and so it just gives you a breakdown of where things stand. Now, what we're hopeful is with some of the technology and AI and potentially some of the regulations coming down, is that we're going to see an expansion of GDP, because obviously having a stronger GDP drives job growth, drives profitability, and so those are the things that we're hopeful that will come out of where we are today in the economic cycle. And then when we look long term, this is really a fascinating chart to me. So this data goes back to 1950. And what we're looking at here is each of these bars represent a decade in time. And the top percentage shows growth in real GDP. And when you start thinking about, well, what drives the GDP? What drives the economic growth? And it's a combination of the growth in workers, so just more people here working, and then growth in real output per worker. So that's another way of thinking about productivity. So if you notice some of the challenges we've had, and I highlighted them here in this red box off to the right, it shows that, we've had a much smaller growth in workers over the last 25 years. And our productivity, the real output per worker has come down, especially when you compare to the 90s or compare to the 50s and 60s. And one of the things that's going to be interesting to see how this unfolds is we do have a challenge with growth in workers right now because of demographic shifts, some of the immigration challenges that we're facing. The question becomes, are we going to start getting some real growth in output per worker, which is, again, productivity? And that's what we're hopeful for. And that way you can see an expansion of this growth in real GDP, because that's what's going to drive wealth over time, is we can get our growth in real GDP up. Additionally, by having that number improve, it puts us in a position to be able to, to service our long-term debt, to pay for liabilities like Social Security and Medicare. So there's a lot that is riding on the ability for us to get this real GDP number higher. And again, I think there's going to have to be a concerted effort to be productivity based, but also a much more planned decision around how do we deal with the demographic shifts in the U.S. and how do we deal with getting more workers here, and making sure that we have a really vibrant workforce, which would include U.S. citizens as well as immigrants that will be coming in to drive the growth in workers. This is a slide on the dollar. So there's a lot of noise here. I think the area that I want to focus is on the left-hand side, and this just shows the up and down of the dollar, basically the U.S. dollar, and it's relative to a basket of currencies around the world, and it just shows the ups and downs. So when you have the peak levels, which you can see at the very top of this chart, we're looking at, let me see if I can get this mouse involved. Back in the mid 1980s, the mid 1980s, you can see here the dollar peaked out, and then we had a period of decline where the dollar lost about 50% of its value. Then we saw a recovery of the dollar, then a decline, and we've now been through a fairly healthy dollar advancement, where so from March of 2008 through September of 22, we saw the dollar rise against a basket of currencies by about 56%. And year to date is kind of interesting. We're seeing the dollar declining around 11%. And so the reality is the dollar day to day is very volatile. It tends to go through these long cycles, and we've just been living through a really strong 15-year cycle. So our expectation is the dollar is going to stay strong but slightly weaken. We've already seen that year to date. And that has some profound impacts on the overall economy. Around how we import and export. And so, but we generally believe that a strong dollar is a good policy. But the reality is, because we are investors not only in U.S. and in international, it does impact earnings over a long period of time. And this was just more of an FYI to really understand the mechanics of this, but we're noticing here in 2025, the international markets are doing well because their stock markets are doing well, but also because of the dollar decline, it makes basically the value of those returns go even higher. When we look at consumer confidence, and so one of the things that when you think about what that means, consumer sentiment index basically measures how people are feeling. And this data is provided to us by the University of Michigan. It goes back, this chart, till essentially the early 70s. And it shows these periods of time, and I'm highlighting the one on the right-hand side, but you can see we go through these ebbs and flows, these ups and downs. And one of the things that this chart is designed to show us is that when sentiment is high, meaning people are positive, generally that means negative. That's negative for the markets, because when everyone is positive, what does that generally mean? That means that the money has been invested. If you're positive, you're going to be bullish. You're going to be wanting to invest in risk assets. When you're negative or your sentiment is low, you're going to be more pessimistic. You're going to be more careful. More of your money might stay in cash because you're worried about the markets. And so you can see where we are today. This is a very bullish sign. June of 2025, our sentiment is around 60. So it's on the lower end of this historical trend going back, over 50 years. And if you look at this box up here, this just gives you the data that supports what I just said. When we look at this period of time, we've had 10 sentiment peaks, which means people are optimistic. And then we've had 9 sentiment troughs when people are pessimistic. And the go forward return on the S&P 500, which means at the point of the peak or the point of the trough going forward, what were the average returns? And the peaks represented a 3.9% return average, and the sentiment troughs represented a 24% positive return for the S&P. So what this would tell you, it's kind of an old Warren Buffett line, is that you want to be fearful when others are greedy, and you want to be greedy when others are fearful. And this chart really resembles that because of the fact that we're seeing, so when sentiment is low, it really drives stronger returns on a go-forward basis. At least that's historical. We know past performance is not going to indicate future results, but this is a pretty long trend that's existed for over 50 years. Then we get into some of the inflation components. So we know that inflation's been a hot topic over the last several years, and it's mainly because what you see right here on this chart. We had inflation peak in June of 2022, which was primarily on the heels of COVID, which involved a lot of stimulation by the federal government. When you saw we saw a lot of money being pumped in. We were putting money in hands of consumers. We were putting money in the hands of businesses. We were printing money at the Fed. We lowered rates at the Fed. So all of these things in tandem created this inflationary spike. So the one thing that we always have to ask ourselves, because the inflation is a hot topic right now, it seems to be on a lot of people's mind, is was this just a one-time deal because of all the impacts of printing that cash, putting in the system, or is this a persistent inflationary risk? I would say that we are of the opinion, and share this with many other investment firms, is that this was just a temporary blip, which did result in higher prices, but that we're going to fall back into some normalized inflationary environment, which is in the 2 to 3% range, which is a healthy amount for the economy. And I know we know that, like, you can see energy is a big driver of that. You can see shelter, housing prices is the dark blue. That's a big part of that. But we do believe some of the inflationary issues have now come back. We do also think that artificial intelligence is going to be a big driver of pushing down inflation, and we have a lot of growth ahead of us. And so, while this was painful going through this, because this chart basically tells us in a summary is that all prices essentially got adjusted by about 20 to 25%, which is a big jump. But now on a go-forward basis, inflation it looks like it's going to be more muted. For those of you who are, I guess, history buffs around interest rates and inflation, this just goes back to 1958, this chart, and basically the dark blue represents the nominal 10-year treasury, meaning nominal, not adjusted for inflation, and then it shows where we peaked in the early 80s at 15% on the treasury, and then we are right now at about a little bit over 4%. And so this is just meant to show you that, the 1980s, 90s, and then basically the last 40 years has been a massive decline in interest rates. And that really shifted here post-COVID. So as we came out of COVID, you can see now we're looking at interest rates to be a lot higher. We do think we're going to normalize the 10-year treasury in the 3 to 5% range. And so we feel like as we look forward, that's going to be the range that the economy can function in, the economy that we should all get used to. And that, the periods where we saw, right here, basically when COVID first hit, we saw treasuries really drop down to almost that 1% range, which is not really sustainable. And it did cause some inflation as well. When we start looking at the Fed and interest rates, this is a question we get a lot, like, what do you think is going to happen with the Fed? And we've already seen that, coming out of COVID, the recovery and some of the inflationary issues, we saw interest rates spike up here. This is the dark gray, this line all the way up. It basically went from a 0% interest rate policy to the Fed funds rate got up to 5.5%. That has now come down. The Fed's cut rates by about 1%. And then you can see a lot of the projections. So the FOMC year-end estimates, which is this dark blue, that represents what the Fed's expectations are, is that they're going to be coming down by the end of this year to be at about 3.9 in terms of the expectation. And then their long-term target is they would like interest rates around 3%. So we're slightly elevated above that. But we do see the rate coming down over time. It's hard to know the timing of it, to be frank. There's a lot of factors that are happening. The stock market's hitting all-time high. Real estate's holding its own. Other type of alternative assets like cryptocurrencies are doing really well. So my sense is that we're going to see some rates come down and get closer to this, from the 4.5 range to 4, 3.5, 3. But it's likely going to unfold slowly over the next several years, barring some sort of shock in the system. And so we're trying to function under the idea that rates are probably not going up, and they might come down slightly. And that's going to have some ripple effects throughout the banking system as well as real estate assets, things of that nature. But we don't think we're going to see a massive drop down or a massive increase, despite some of the headlines that we do see out there. So that covers our economic update. Our next section today, we're going to cover fixed income updates, which primarily has to do with what's happening in the cash markets and the bond markets. So a lot going on here. So the headline, cash on the sidelines continues to reach historic highs, but still trails bonds. So on the left-hand side, it shows the money market assets that are on the sideline. So you can see as of June 2025, we had roughly $7 trillion of cash. And that's a crazy big number, right? So from 2018, you can see on here, we went from 3 trillion to 7 trillion. And that's over 100% increase. So it shows you how much cash is out there. It also shows you essentially why we had some inflation in the system, because there's a lot of money was printed. But if you look back at this and you see some of the charts, like 2008 was when we had the financial crisis, we saw a peak in cash levels. And so how I read this is that there's a lot of investors that are parking money because of uncertainty. Also, money market rates are offering attractive interest rates, right? We're seeing 4%, and essentially for 15 years prior to this, we saw interest rates on money markets at close to zero. So the positive side of this is that on a go-forward basis, this tells us that the stock market, the real estate market, riskier assets likely have some more upside, because this cash may not always want to be in cash, and it has to find a home. And where's it going to go? Short answer is no one knows. Is this money going to be allocated towards bonds? Is it going to go to stocks? Is it going to go to real estate? Is it going to go to crypto? Where's it going to go? The reality is it's probably a combination of all of the above. And so that should bode well for the future of the financial markets, because we have a lot of cash on the sideline that, again, eventually will find a home, especially as the Fed cuts rates. We all might be satisfied with getting 4% on our money when it's at 4, right? If we're getting 4, like, hey, this is kind of not a lot of risk here, I feel confident. But what if the Fed cuts rates to 3, right? And all of a sudden I'm getting 3% in my cash. I got to pay tax, so maybe I'm left with 2 or 1.5. Then you have inflation, right? So eventually, as rates come down slightly, like I mentioned before, you're going to see this money get put to work. Now, on the right-hand side, this basically shows like, okay, well, we know like cash is doing okay, but typically when you look at, the environment we're in with this much cash on the sideline, how does it do on a 1-year basis relative to bonds, relative to stocks, relative to like a diversified portfolio? So, this stat basically shows over the last year, 93% of all bond mutual funds and ETFs outperform cash. And so we've definitely been a big proponent for getting our clients out of cash and T-bills, like cash equivalents, and getting them into bonds or some longer term assets that we think have some better return characteristics. And that's something we're having individual conversations with clients. But I think now is a really good time, if you haven't already addressed this, especially if you're on this and as a prospective client, is to really evaluate what's the appropriate mix here. One of the things we were trying to guard clients against is sitting on too much cash, so when rates drop, they're going to see a drop in their income, and obviously that's less than ideal. When we start looking at, the Fed funds rate above inflation is really positive for the bond market. So if you look at there's a box off on the left-hand side that says the May 2025, the Fed funds rate was at 4.3, and the inflation rate was only 2.4, right? So there's a difference there. And so what this is telling us is that when you have this level of a gap, that bonds tend to do better on a go-forward basis, when the Fed funds is above inflation. And so this is a good sign for owning bonds, at least by historical data. And so that tells us that if we've been sitting in cash, this might be a good time to really look at some of the opportunities to get some potentially higher yield, but also potentially lock in with adding some duration and looking at for some of the opportunities. There's a bunch going on here on the right-hand side, but it just basically reaffirms that same point. So one of the interesting things that we spend a lot of time is talking about diversification, right, and really looking at managing money. And when we think about what a balanced portfolio is a combination of how much do we have in cash equivalents, in bonds, in stocks, in real estate. And when we look at this idea of like a 60-40 portfolio, right, this would be 60%. I think for this example is 60% in the S&P 500 and 40% in a bond index, which I believe is the Barclays aggregate. We might be using actually, this looks like it's a government index. And so what this chart shows you is that on the left-hand side is that, since 1926, which is the bottom, a typical 60-40 portfolio has about a 66% upside, right, and about 57% downside. So what that means is that, in lieu of just buying the whole market or compared to against just owning the market, is that you're not going to get the full upside of the market, but you're also not going to experience the downside. That is what positive diversification looks like, is this 66 up to 57 down. Well, on a trailing basis, I guess we're looking at, on a 5-year. So on a 5-year trailing basis, look at the numbers here. That a balanced portfolio, 60-40, has gotten only 67% of the upside, but had to experience 74% of the downside. So I think that's left many investors frustrated. I do think it's the dynamic of interest rates going up quite a bit post-COVID that's caused this downside capture. So I think on a go-forward basis, the numbers will improve if we have the benefit of hindsight to look at this. But just wanted to acknowledge that this was a tough stretch for diversification, because we've all known, hey, if I own bonds or cash, it's really safe. But this last 5-year period has been a tough time to have that level of diversification and that type of mindset, I should say. Lots going on here, but this basically just shows that, current yield is a really good indicator of future return. So right now you can see this dot here that says, okay, our current yield on a bond portfolio, the U.S. Ag, is around 4.5%. So our forward 5-year return is probably 4.5%. So yields match up pretty closely to this. And so just trust me on this, is that when you look at where the rates are today, that does help us with a pretty high level of certainty predict what the next 5 years are going to look like, which is why people gravitate towards bonds, right? Because when you can have some more predictability, that makes investors feel safe. It also helps from like a spending and a planning perspective to be evaluating that. Our next topic is tariffs, definitely in the headlines every day, and I'm going to try to avoid all the political landmines around this concept and just keep it to some of the facts that I'm seeing and the impacts. And so we're going to dig into that a little bit, and then we can summarize. But let's just deal with what is happening. Let's try to take Washington out of this. Let's try to take Trump out of this conversation. Let's just, at face value, let's try to unpack the tariff conversation. So I tried to pull some articles. So this was from the Wall Street Journal on July 18th, and the headline here is Corporate America Shoulders the Burden of Tariffs. One of the things that I think a lot of people were concerned with, a lot of economists and investment strategists, is that, well, this is just going to be a tax on consumers. And what we're seeing so far is really, it's like corporate America has been essentially eating some of this additional tax revenue, this additional tax cost to their business. And if you look at the right-hand side, it really shows like, okay, well, how much of these duties, tariff duties, have we collected? And you can see 2024 versus 2025. So it's been pretty substantial, about $55 billion additional. And it looks to us like it's just being borne by corporate America, which we know eventually trickles down to the end consumer. But that hasn't been the case so far. We've seen the ECB, which is the European Central Bank, they're holding rates steady because they're concerned about tariffs. So, one of the things we don't like about tariffs is that they're creating uncertainty, and, uncertainty on the surface is not a terrible thing. But if you're running a country, running a business, being a consumer for you individually, uncertainty will oftentimes lead to a delay in a decision. Because if you're not certain what the future holds, you might delay a consumption decision. And that can have a trickle-down effect in the economy, because if everyone delays the decisions altogether, then that means the economy will slow because of the lack of that consumption. And so you can see here they're holding rates. They've been cutting rates. You can see the ECB is this slightly green line here. They've been cutting rates quicker than the Fed because their economies aren't doing quite as well. Now we can get into some historical data looking at tariffs. So this goes back to the 1900s. So on this chart back here, like this period of time is basically in the 30s. So you can see here we saw tariffs were pretty much a normal part of our economy, and now over the last 60 years, 70 years, it's been almost negligible. So what we're looking at here is on the far right is like, okay, well, where are we today? So when we were having some of the peak conversations around tariffs, there was this fear that it was going to be a 30% number. Now we're saying, okay, the effective rate might be closer to 15%. And, Trump has stated essentially that he wants this in the 10 to 15% range. And I don't know if you all saw the headlines here as of late, but in June, the Treasury had a surplus. They collected more revenue than they spent. And so that's a great thing, obviously, because of the massive debt problems that we're having. And so it seems to me like this is being used for negotiation. We'll get into this a little bit, but you can see here that a lot of the data, these were two different data sources, that it seems like this 15% is essentially be the average rate that we see, and that's through some countries getting preferred tariff rates, but then also looking at some, we're going to get some of these reciprocal tariffs that are pretty high because of just maybe some of the anti-competitive, effects on the U.S. economy, and that might cause some of these tariff rates to be higher. But it looks like we're going to settle into this 10 to 15. 15 is what we're projecting right now, but that might change. This is just kind of the tariff policy. I think this has made everyone's head spin this past, let's say, 4 months, where, early April we're at 23%, and then we had semiconductors, and you can see all the headlines here, 28%. Then there was like a tariff reduction that, U.S. and China had a 90-day deal, and then the U.K. had a deal. So there's all of this noise happening. And again, this uncertainty might lead to a slowdown in the economy. So far, it hasn't. That is obviously our concern, is that if we don't have a set strategy, it will have the outcome of business owners delaying decisions, which then is not great for the economy long term. But in the near term, it has not really been an issue. So let's kind of go through some of these numbers. And so these numbers are changing. You can even see here, I guess the last data we pulled, not off those charts, was that the tariff rate's in the 17% range. A lot of these increases are targeted at China, on the EV side, semiconductor, solar panels, in the steel industry for sure, trying to protect our U.S. steel industry. Some of the policy intents, again, I want to stay away from the political side of things, but at the end of the day, I highlighted this on here, is just this idea of reshoring. I think going through COVID, many of us realize that we're so dependent on manufacturing outside the U.S., specifically in China, where most of our pharmaceuticals are made, most of our chips are either being made, where our iPhones are being produced. And so the whole idea is, how do we reshore more of this? And so that if we have any global conflict or any future issues, that we have more of this manufacturing done here in the U.S. And so there's definitely policy intent around there. And I think if we could summarize it pretty simply, it's in this idea of reshoring. And there's going to be some supply chain risks that are not going to go away. I don't think this noise is going away. I think this is going to be with us probably all of Trump's term, but for sure the remainder of this year as they get through the deals and the negotiations. A headline I'd even prepare for this, but it looks like there's negotiation with the European Union as of just a few days ago, which is obviously a positive. Anytime we can get through the negotiation and get to a deal is good, because then we can move forward. Because once we have rules to play by, it makes the economy function much better. Some of the areas that potentially could manifest themselves short term, import prices may rise, which could cause some inflationary pressures. The data that I've seen on corporate margins, this could infect profits, and I think that's the concern for the stock market, right? Is that if there are additional costs that companies have to pay, what's that going to do to their earnings? The data that I've seen is that on the whole economy, it's fairly insignificant. It's a pretty small percentage, and so that each company might have an impact. When we look at the broad markets, that the corporate margins being compressed and hurting earnings is not going to be is fairly insignificant. But certainly, we're seeing a lot of headline risks in the short term. You can see some of the sectors that are more vulnerable to this: retail, auto, electronics, and then obviously there's some beneficiaries, right? We're seeing industrials do better, domestic manufacturing, things of that nature. And then, the interesting dynamic is, I think that there was a lot of chatter early on is, this might just be a temporary threat. This might just be noise out there right now. But it seems to me that this is going to be a permanent policy, at least for the Trump administration, around generating revenue for the Treasury. So this looks like this is going to be something that will be with us. And we'll see the longer term impacts of modest levels of these tariffs. All right, the next topic we're getting into is new tax legislation, the OBBBA, the One Big Beautiful Bill Act. So again, I think trying to stay away from the political dynamic of this, let's talk about what it is, how this is impacting the planning that we do for you, the planning you should be doing for yourself, how you're going to work with your CPA. And so there's a bunch of changes here. There's a lot to cover. So let me just dive right in. So the key highlights. So the 2017 Tax Cuts and Jobs Act were made permanent. So this was what was passed in Trump's first term. And these were set to sunset in 2026, which basically meant that without Congress acting and the president signing it, that we were going to see a fairly massive increase in taxes in 2026 across the board. And a lot of that was going to be born, everyone was going to feel it, but as a percentage of income, the middle class was going to feel it even more. So it was really important to get this bill passed. We could certainly debate the ins and outs of things that maybe should have happened that didn't, or shouldn't have happened that did. But the reality is they're made permanent, so those are the laws we're going to live by here, and that's the planning that we're going to do as a firm to help guide you through this. So some of the things that have happened from a standard deduction and itemization changes, the standard deduction remains doubled and indexed for inflation. I think the most significant here is the SALT cap. So that's you can see as the third bullet point down. Basically, it increased from 40,000 from 10. So this is pretty significant. So what that means, it's state and local tax deduction. So if you live in California and you're a decent earner, you're likely between property taxes and California income are going to have, where your state and local taxes will be 20,000, 30,000, 40,000, 50,000, 100,000, just depending. And so that $10,000 cap really increased your tax liability. So there's now a $40,000 cap. Now, I will tell you that if you're a higher earner, so if you're in the top 1% of earners, which puts you above 600,000 in modified adjusted gross income, then your cap is actually 10,000. So that's the bad news. So this is going to have a big impact on the middle class, upper middle class, people making between, let's call it 150,000 and 500. If you're in that space, 150 to 500, this is for sure going to help you, especially if you're a homeowner, because you're getting this increase to 40K. So just more deductions essentially. But if you're above 600, bad news, you're not getting any help. We also looked to see if there's any Medicare premium surcharges. So if you're of Medicare age, at this time there were no changes to that. All right, now we're going to jump into some of the weeds, and I'm going to move through this pretty fast. These are certainly things that you can look up. If they apply to you, then this is something you'll want to dig into with your accountant as you go into your year-end planning. So there was some expanded family and age-related benefits. So a child tax credit increases. If you're above 400K, you phase out. You get some additional above-the-line charitable deductions. Not super significant, though, because it's only 1,000 to 2,000. One of the cool things they put in place for retirees is that if you're individual over age 65 and you're in the, let's say, middle income or lower, you're going to get an extra $6,000 deduction. So if you look at the chart we put together, I think the area we can focus on is right in the middle. It says new senior deduction. So if you qualify, if you do not phase out, if you're single, you're going to get an extra $6,000. If you're married, filing jointly, and only one of you is 65, you're going to get $6,000. If you're both 65, you're going to get an additional 12,000. So when you start equating that to what does that look like at a tax level, that could, at the higher level, both of you over 65 could be an additional $2,000 to $4,000 a year that's in your pocket. So that's definitely a nice benefit for those that are in the over age 65 category. This was the one I think, so there's some new deductions for tips and overtime. This is definitely one that was most celebrated, I would say. People were really excited about not paying tax on tips and overtimes. There's a bunch of rules here, and I think most people are not super pleased about how this played out, but there are some rules that we need to be aware of. So for tips, the max deduction is $25,000. This is based on a single earner, so $25,000. Depending on your filing status, you can see there's phase outs. So if you make over a certain amount, then you still have to pay tax on tips. Overtime, it has the same phase out thresholds, but it has more to do with whether you're single or joint filer. So essentially, what this means is that if you're a joint filer using this data, and you're up to $25,000 of overtime income will not be taxed as long as you're below the phase out limitation of $300K. So if you're above that, it begins phasing out. And so again, this is depending on where you fit in the income spectrum. This could have a pretty profound benefit and save some monies. So these are temporary though. They're only applied to tax returns 25 to 28. And then you still have to pay Social Security tax, Medicare tax. It's only the federal income tax that's basically not taxable. And I guess they're going to have to report tips and overtime separately, so it's going to get a little bit more complicated for payroll systems. There's another account that was set up called a Trump account. Now, given that Trump is going to be president here for a couple more years, I would have preferred something a little bit more of like an America account. So that it was a little bit more neutral, because I don't want the name to turn people off as saying this is not I don't want to invest in this, because these are kind of cool vehicles that I wanted to share with you. These are brand new. There probably will be changes along the way, just like there has been in the past, like when the Roth IRA was first launched. There's been changes over the years, but essentially the Trump accounts, it stemmed off this idea of invest for America accounts. It was a couple venture capitalists that floated this idea out, and they got it passed. And so basically you can see all the specs here about what happens here. So basically the Treasury will fund $1,000 at the time of birth for children between basically January 25 through the end of 28. So it looks like this will be needed to be passed again to go on to people in 2029. So it's for this to carry on as a permanent plan. I think they're probably testing this. The annual contributions that can go in there by family or employers is $5,000 a year. So that's the cap. And then there is similar to like an IRA. So it's tax deferred. And there's no deductions for individuals. And basically, those are some of the details. And you can look on the right-hand side. We said, okay, for parents, employers, or relatives, no deduction. One of the cool things here for employers, the note I have there is possibly. So I think they're trying to get this so that if an employer decides, so let's just say as a firm, Vance Wealth says, we're going to put $1,000 into any of our employees' children's account if they qualify, right? And so we could fund that ideally as an employer, because I would be putting this in as a fringe benefit for the employee. That it would be great if that would be deductible. But right now, it's possibly that is still under review. So stay tuned more for that. One of the knocks on this is I just keep reading. They're like, oh, this is not very good. It's not going to do anything. But I ran some of the numbers. It's pretty crazy. Now, we know the benefit of compounding, so you bear with me on this example because I went out pretty far. And I said, so the initial investment is $1,000 at birth. Let's just assume you put in $1,000 a year until age 70. You got a nominal return, which means before inflation 10%, inflation rate 3%. And then we invested over a 70-year period. So the top result is that the value of that account, based on that math, would be worth just shy of $9 million. But inflation adjusted, it's $1.5 million. So that's the important thing, is we have to do it in essentially in today's dollars. So $1.5 million. But that's pretty significant, right? So if everybody, by the time they got to 70, had in today's dollars $1.5 million, that would be a pretty significant win for individuals. and not at a huge cost. Now, right now, the Treasury is not set to fund all that 1,000, so it would just be the Treasury to fund the 1,000 at birth, and it would be up to employers or relatives or family to do the other 1,000. And then you can see, you know, what I just said, hey, what if you compound to 60? You can see it's still a nice nest egg of nearly 800,000 in inflation adjusted value. So kind of a cool idea. We'll see how these take off. Again, I think an Invest in America or Invest for America accounts would have been a better name. Okay, new deductions. So there's also a provision put in place that up to 10,000 of auto loan interest deduction for American assembled new vehicles. And there you can see on here there is phase out. So if you're married filing jointly and you make over 200,000 or 250,000, you're fully phased out. This is kind of a cool feature here. It's obviously just subsidizing the U.S. auto market, but on new vehicles, depending on how much you make, you're going to be able to deduct some of that auto interest. Green incentives expiring. So you can see the residential solar credit ends after this year and the EV credit expires September 30th. So if you're looking for getting some of these credits, you got to jump on them now. We're running out of time. All right, this next section is on small businesses. So if you're not a small business owner and you're looking at our chapters, you might want to just forward through this because it's going to get kind of technical. So I'm going to run through this. This is certainly something that we're going to be having individual conversations with our clients. A lot of these changes are affecting going forward on 2026. So it's important to be aware of them. But basically, they created some new thresholds for qualifying for QBI, which is qualified business income, which basically gives you you get a 20% deduction of your profit on your tax return. So it just lowers your taxable income, which is great. And then you can see there's different phase outs. And so they essentially widen the ranges of phase out. So effective 2026, if you're married filing jointly, your phase out begins at making income above 384,000 and it fully phases out at 534. So with these notes in mind, like we're excited because as you all know, we do tax strategy for clients and really help them with the planning side of things. And so with these thresholds, then we're going to really be doing our hardest to make sure our clients can maximize this out because the qualified business income deduction is really powerful, and we want to make sure that we take advantage of what we can. So areas where we can accelerate deductions, take other deductions, can be really critical, so that if we fall into these phase outs, that we can maybe get extra deductions to move us below, right? So again, the new rules apply for next year. And I'm sure there might be some changes, but it looks like this is going to be a permanent part of the code, which does benefit a lot of businesses. If you are a SSTB, which is a specified service trade business, which we are as a financial services firm, doctors are, then this phase out is what applies to you. If you're manufacturing, meaning you make stuff, whether it's you make cars or you make tubs or you make pipe or you do something, then you're not subject to these phase out and you get this 20% deduction across the board. Another component, so for businesses that are growing and spending a decent amount of money, there are some new rules around bonus depreciation in Section 179 on expensing. And so the OBBBA outcome is basically the bonus depreciation, which means to be able to accelerate the write-offs. It was phasing down. This year it was going to be set at 40%. Now it's permanently restored to 100%. So this gives us a lot more flexibility with planning. As many of you know, we are not big proponents of always take the bonus depreciation. It depends how high your taxes are and what tax bracket you're in. But this gives us flexibility to make the right decisions and really be more strategic here. And then you can see it increased this 179 deduction limit to 2.5 million. And then the phase out threshold at 4 million. So there's a lot more flexibility we have here, which is great because it gives us, as doing tax strategy, tax planning, it gives us just more flexibility and higher limits to make some more impactful decisions for most of our business owners. Next one here. So this is pivoting from small businesses. Now we're going to pivot into a estate planning section. So the new part of the code, essentially, you can see all the notes here, but we just made it a permanent. This was set to expire. It's now a permanent part of the code, and you can see some of the. We'll just start with maybe the single exemption in 2024. The exemption was 13 million. So that means if your estate up to that 13 million was not taxable, over that it was taxable. 2025 it was right now at about 14, and then 2026 it's going to 15. So the math's really simple. So for 2026 and going forward, it's 15 if you're single. Married exemption is 30. And it's permanent and it's inflation adjusted, so these numbers will go up. Other thing we get a lot of questions about is the annual gift tax exclusion. So for 2025, the annual exclusion is $19,000 per recipient. Last year it was $18,000. So as a married couple, you can essentially give $38,000 per recipient without triggering gift tax reporting. And just to note, the amounts we have here on the estate planning, if you notice on the headline, it says lifetime gift and estate tax exemption. So while these levels are most of the time applied upon death, these can be used during your lifetime as gifts. And so that's where a lot of the planning that's going to be coming up for our clients is we know this is permanent, so we need to look at estates. These are larger estates, so we can start advising on how do we make the best decision given that this is now a permanent part of the tax code. And then just summarizing some big items we're going to be looking at. What are some of the planning opportunities around this? Obviously consider itemizing if the SALT cap increase or charitable giving puts you in the over the threshold. We're going to really want to review entity structure and tax elections for your pass-through businesses to make sure you're taking advantage of these different deductions like PTE and QBI. If you're in the market, you should act on green credits before the expiration. It's really important to review your estate plan because of the higher exemption amounts. Again, before we had a sunset risk, so people were delaying. So now that these are permanent, we should be looking back at our estate planning documents and make sure they're still relevant. And then bonus depreciation and QBI changes create room for year-end tax planning strategy sessions. And so that's going to be really important to us is, okay, looking at expenses for businesses, how do we help them maximize the appropriate deductions that make sense from a long-term tax perspective. But please ask your tax advisor, and we'll be coordinating with your tax advisor as well on how these would impact your specific situation. Next topic is the stock market. So we're going to give a stock market update here and share with you what's been going on. So a little bit of a crazy year. So this just shows a short period of time. So beginning of the year through April 4th on the S&P 500, with all the tariffs, I would call it tariff scares is probably the right term to use. We saw markets correct quickly. It was a 15% decline. It happened over 4 or 5 weeks. It freaked everyone out. We've now seen the recovery from those levels, but we saw a really sharp decline. This was a Wall Street Journal article just from on July 23rd. The headline kind of cracked me up, like, why are stocks up? Nobody knows. Well, at the end of the day, you can see this chart here, right? And, firms like Goldman Sachs had all these targets. At the beginning of the year, they targeted 6,500. Well, when the markets were collapsing, they reset their targets to 5,700. Now they reset it. So, there's always a moving target. So a lot of these short-term predictions, again, are not very useful. The reason why stocks are up is because we're looking at an economy that is growing. There's a massive spend that's happening in artificial intelligence, and that's trickling down to so many different industries as we're making sure we have plenty of power, plenty of chips, plenty of infrastructure. And so that's driving it. Now, could we argue that stocks might be a little expensive? Probably, but that doesn't mean that they shouldn't be going up. And so there's a ton of bad news. And we talked about this earlier, is the reality is, like, bad news is not necessarily bad for stocks, because oftentimes that means that stocks have corrected, there's good opportunities to enter. And so, while we had a bad start to the year, we're sitting in a decent position today. This now shows you the full, decline in recovery. This goes to the end of June. We're now close to the end of July, so the data, we're even hitting all-time highs. But you can see all the headlines here, right? We had this Liberation Day tariff announcement. We had Trump accusing Powell of playing politics, all of these headlines. It's been kind of a noisy year, but, at the end of the day, this happens a lot. Like the markets are designed to be volatile, and, there's always a headline of the day, right? And too often we get hyper-focused on that and not focused on the reality of, like, over time, markets are generally going to go up. And so we want to trust that process of longer-term assets like stocks are driven by future earnings. Those are assets that over time go up, but with plenty of volatility as well. So now we're going to just reflect on just some of the things that are happening. So the best May-June for stocks since 1950, but international stocks are actually outshining U.S. from a total return perspective. And so you can see here, year to date, U.S. stocks are up about 6%, and international stocks are up around 19%. That window is closing because U.S. stocks have now recovered. I'll show you some data here as we get into year to date. And this is through the end of this is through July 28th. S&P is up almost 10%. Russell 2000, which is smaller companies, is up only 2. You can see, looking at international, which is the bottom, or two of the three bottom, MSCI EFA and MSCI EM. This is Europe, Asia, Australasia, and the Far East, and then EM is emerging markets. You can see both of those indexes are up north of 20%. And I think that's been a surprise. A lot of clients, as we were going through this, the tariff tantrum, I should say, we had a lot of clients like surprised that the portfolios were holding up well, and I think a lot of that was driven on having some international diversification, having bonds really being well diversified and balanced. And now we're coming out of this. Now that we fully recovered, returns are quite healthy so far for this year. But again, we know that that could change overnight. We could be once this webinar is released, we could have a tough August, September. You know, the reality is we definitely want to always focus on long-term results, even though I know today we're focusing on some of the short-term areas of what's happening. But again, this is more just to help you better understand what we're seeing, what's happening in real time. When we look at valuations, I think that's where, you know, over time, valuations matter. If you overpay for any investment, future returns are not going to be as good. And if you underpay, when you buy things cheaply, they're generally going to result in pretty good returns. So this chart goes back to 1994. And, you know, without making you an expert on price to earnings ratios, it just basically measures, you have a higher price to the ratio of earnings. You would put yourself at the top part of this line. So up here, meaning you have higher price relative to earnings. Down here, you're lower price relative to earnings. So right now, we're at some historically higher levels. We're above our 30-year average, which again is why we're starting to have the chatter of some higher, you know, some of these higher returns. And so if we get back to the late 90s, like the reality is we had some of the same things that were occurring in 98, and the market still had 2 more strong years. And so we do need to be diligent. We do need to rebalance accounts and make sure we have the appropriate risk in accounts. But we are a little bit stretched from a valuation perspective. But again, that doesn't mean that that has to turn. When we also part of the conversation we get with clients a lot is like, oh, the markets are hitting all-time highs, like is now a good time to invest? And there's a ton of stuff on here, but basically the summary of all this data shows that, like, you know, since the start of this year, this was since the start of 24, we've had, you know, 62 days of all-time highs. And, you know, basically the markets tend to close, you know, like 7% of the days are when the markets close at these all-time high. And 29% of those all-time highs also act as the market floor. So the reality is, like, using this idea of I shouldn't invest because we're at all-time highs. Frankly, markets by design are hitting all-time highs just with the nature of how the markets are built, is that, you know, over time, stocks should be hitting all-time highs and real estate should be hitting all-time highs. Day to day, not so much, but over time, yes. And this was another chart, again, gets into the weeds a little bit, but it basically says high stock valuations have not historically predicted near-term performance. So this table on the right-hand side, you know, goes through and looks at some different periods of like higher PEs. And, you know, like in the late 90s, high valuations did result in negative returns. But in 2018, higher valuations, you know, the 3-year returns were quite good. In 2021, you know, post-COVID, we had higher valuations and we still had really strong returns. And so just because we have some higher value, we're in a higher valuation environment, doesn't necessarily, that should not impact our short-term decision-making, because it's a mixed bag in terms of being a good predictor for long-term strong market performance. When we look back at, like, you know, the power of compounding, that's what I always like to focus back on. This chart goes back to 1995, essentially starting with $10,000 and adjusted for inflation. You can see cash is worth $9,200, right? That's adjusted for inflation. So it's kind of the definition of what you want to avoid. Assets that over time are going to lose their value. Then you can see corporate bonds, you know, a little bit better, you know, but remember, this is a 40-year period, and your money, you know, real dollars is you know, up 2.3. And then you can see large and U.S. stocks, large cap stocks, small cap stocks, you know, are up 8 times over this period of time. So that's why we're big proponents of being long-term investors, is because of the dynamics of what happens in the markets. But if you look, there's always snapshots you can take. Look in 2008 when we went through the financial crisis, the returns on large stocks, small stocks compared to bonds and cash was much more closely aligned. but when you compound over a long period of time, that's where the gap grows historically. It's done that for the last 100 years. So this is really, we understand the risks of the markets, but this illustrates the power of the compounding mechanism that the markets deliver. All right, we're going to jump into some alternatives. Real estate, gold, oil, crypto. We're going to run through it. I did find some pretty fascinating topics to jump into. Hopefully you enjoy some of the slides. Sorry, just need to grab a little water. All right, so let's jump into real estate. So I'm going to do a rapid fire through this, so you can read some of the notes below. But basically, this goes back to the 1960. Home prices were at 20K back in the 60s, over 500,000 today. This is in nominal prices. We've obviously had a pretty sharp appreciation post 2020, which was post COVID. You can see here we saw this big spike up because we had really low rates and there was high demand. It doesn't count for inflation or home sizes. It's just pure pricing. This next chart then shows Case-Shiller National Home Price Index, which just shows national home price appreciation. And you can see, this index going back, this data goes back to the late 80s. It just gives you an idea of what's been happening from a price point. And you can see here, we had this dip during the financial crisis and then the bottom out in 2012. And then we've seen a really healthy rally post 2012, I should say, or post 2008, and then again a massive surge here with when COVID hit and post in 2020. When we look at real residential prices, I found this even more fascinating. So this one just shows like the true index. This one shows real. So we've finally over the last several years got above the previous high in 2006, and from a real perspective, when you adjust for inflation. And again, a big part of what got us there was that we had low interest rates. Well, the reality is over the last 3 or 4 years, you can see prices have really stabilized, and we're not seeing a lot of upside here because of interest rates being higher and some pressure on affordability. And then when we look at all transaction, like the home price index for California, so like California prices have 9x'd since 1980. They really outpaced national trends. We did see a significant drawdown in 2008 to 12. We've seen this run up here, and we're still seeing home pricing do well. But it definitely the appreciation is beginning to slow in the current market. So hopefully that's helpful just to give you a snapshot of where things are. So real estate market, there's definitely a lot more inventory. Home prices are leveling off, and frankly, that's healthy. We went through an unhealthy period of time. Real estate, we shouldn't see prices. Like if you look here post-COVID, we shouldn't see prices jump up in a 2-year period by 30%. That's just not healthy. It's not sustainable, and it really disrupts a local market. As homeowners, we like it. Our homes are valuable, but it's really disruptive for just the overall employment environment, workers coming into the area. It can be quite disruptive to that. And so seeing some more price stability is a good thing. It's healthier for the economy, in my opinion. Okay, when we jump into gold, gold's been a really good performer here as of late, so it's definitely hit the headlines. This does show gold going back to 1970. So essentially, we had a period where, if you look at the chart down here, from 70 to 80, gold did extremely well. It hit this, price point relative to the market, this massive gap. But then from that time to about 2000, the stock market, did significantly better. And then gold has been on the ascent for the last 25 years. But what this shows you, the S&P has been a much stronger grower, right? That doesn't mean that's always going to be the case, but that has been the case. And my sense is, when you're investing in the markets, you're investing in companies, right? You're investing in NVIDIA and Apple and Amazon and Google, these companies that are generating profits, generating revenue. And so you can see pretty substantial difference there. More volatility when it comes to the equity markets, but equities have outpaced gold over the years. And while gold might be a suitable diversifier, we still feel like being in equities long term is a most important place to be in terms of just having growth assets. One of the things that people talk about, investors, economists talk about is that, we're going to put gold in there because it's a good inflation hedge. And actually this shows you that it's not a great inflation hedge. So between 1970 and 2024, gold has delivered positive annual returns just 58% of the years. the equity markets are closer to 75%. And so, even so, there are some periods of downside, especially when you look at inflation. And so, a lot of times we look too much at the near term, like what's happened recently, and try to forecast that long term. And so we've been in a healthier environment for gold as of late, but that trend can absolutely change. So just be mindful of that. Oil markets, and so I do think it's part of this current administration goal is to get oil prices down, knowing that the price of oil, the price of energy trickles down into our economy. One of the ways to keep inflation under control is to drive down energy prices, and so we can see here we saw a spike up here. We had a massive hit during COVID when the economy stopped. And now we're in an environment where we're seeing pricing come down, and so I think we'll start seeing per barrel in the 60 to 80 range seems to be pretty healthy. Not sure if it's going to go below that. This chart on the right also just shows that we are in a net export environment. So we went through the 70s, 80s, and 90s as heavily relying on importing oil to drive our economy, and now we're an exporter, which is pretty amazing. Okay, and then the last part of the alternative section is looking at some crypto regulation, market snapshot. So there's a Genius Act was just recently passed. It basically created rules for crypto exchanges to protect investors. It basically requires the platforms to verify users, show proof of reserves, meaning they have reserves that back what they say they're going to back, follow stricter security standards. So this is all good stuff. It just provides the industry a lot more legal certainty. And so that there's a framework to work inside of. In terms of what's happening in the crypto market, like Bitcoin is about 118,000. Year to date, it's up 78%, so it's had a massive run. Ethereum, which is the second largest crypto, is up about 15% for the year. Year to date, it's done quite well. The SEC approved spot Bitcoin ETFs, which means you can just buy it as an ETF inside of a portfolio, inside of an IRA, inside of a brokerage account, which is allowing for more mainstream adoption. And I think just having clearer rules, there's more growing investor confidence. The reality is, for people investing in cryptocurrency, and digital assets, the amount of volatility there is massive, right? You've seen periods of time where you've had 80% sell-offs in these positions. And so while they might be an important part of a portfolio, or could be an important part of the portfolio, the volatility needs to be understood there better. So if that's something you have questions with at Vance Wealth, we have built some of this into some of our models, looking at using the Bitcoin ETF. And so if you'd like to unpack that a little bit more, please feel free to ask your advisor to provide some more details around that. International stock market. So let's cover what's been happening around the world. Lots of going on here. Essentially what I want to focus on is that we're seeing international markets do quite well this year because of two things. The markets are doing good. You can see this here. They're up about 9%. But then we're also looking at the fact that the U.S. dollar has declined. In U.S. dollar, the returns are almost double that. So they've been benefiting from a strength in the weakness in the U.S. dollar. One of the things that I did find really interesting is if you look back to, let's say, going back to 1987, the U.S. market, from a market cap perspective, only represented 30% of the overall market. You can see this down here where my mouse is. And the Japanese market represented almost 40. Fast forward to today, the U.S. market's at 64. Europe, ex-UK, is 12%. The emerging markets are 10%, and Japan is 5%. And so, you tend to see these strong periods of rallies. We do think that we're going to start seeing this shift a little bit and start seeing the percentage in the U.S. come down a little bit. To what level, it's still unknown, but we do think we're going to start seeing this has been an era of really massive underperformance in international for the last 15 years, and we think that's going to shift a little bit, mainly because valuations are more attractive. But we still have a massive U.S. bias. I think even probably slightly bigger than this from a target allocation perspective. But we want to look at the global equity markets because we believe that's important for diversification. Again, I alluded to this earlier, is that we're seeing that with the dollar weakening, that international markets have done well. And this red line here, year to date, is we have the dollar weakening, international is up 20, U.S. is up 6. So pretty significant outperformance on the international side of things. But again, that can change. We do think that we're in a period where international stocks will likely benefit because of just valuations look really good in those areas. But at this level for us, what we're doing is we're not necessarily trying to make a prediction. We believe in balance inside of portfolios, and so maintaining a healthy mix, U.S. biased for sure, U.S. emphasis, but adding some internationals for some international companies for long-term diversification for our accounts. This speaks to underperformance, outperformance. So when we look back to the early 90s, you can see, or I should say the mid 90s, you had this purple represents when U.S. outperforms international. So, and then you have a period of like the declining dollar, which is international outperforms U.S. And then we've been living through essentially since around 2010 until today. So about 15, a little bit over 15 years where international has really underperformed versus the U.S. So some of the stuff I mentioned earlier, but this is the graphic that shows this. And so we know these will tend to go in longer themes, longer cycles. But at some point they do shift, and that's an important thing to know about the economy is we will see these things ebb and flow over time. All right, artificial intelligence. So it's going to be a quick section. This chart right here on the left-hand side is measures CapEx. So how much capital expenditure is happening. And you can see back in, basically the capital spending that's happening from Alphabet, Amazon, Meta, Microsoft, right? What they are known as these hyperscalers. So back in 2020, they spent about $72 billion. Now they're expected, that in 24 it was, around 200 billion this year, close to 300 billion and growing. So massive amounts of spending. And then you can see the percentage of cash flow that's being spent in terms of in the to promote their artificial intelligence growth. So this is a massive tailwind for the economy. These numbers are just probably would have never fathomed them. If we had a conversation 5 years ago, trying to think of they're going to go from a 72 billion spend to starting to average 300 plus, would just not have been something that I think we would have forecasted. When we start looking, this is a little bit noisy, but going back to 2020, we looked at, what about artificial intelligence funds? We have gotten calls from clients like, hey, can you put me in an AI fund? And I guess the long and short of what we're seeing here is that generally we want to be a little bit more diversified. I think the AI funds are kind of like catchy and they're popular, but they tend to have higher fees. And at least historically, you can see a lot of the AI related funds are all in this light gray. Except for one there, you can see they've underperformed just the broader S&P technology index. Most of them have underperformed just the Russell 3000, which is a broad index. And so just be careful there. It's something we are willing to look at, but from a core portfolio perspective, we're not investing directly just in these because we think these themes are happening everywhere. In fact, when we look at like AI company exposure, as the overall market, 42% of the market cap of U.S. equities are essentially AI companies or companies that are profiting from AI. And so you already have a lot of exposure both in your U.S. and your global equity portfolios. So now we're going to pivot into a conversation on the Magnificent Seven. That would represent Meta or Facebook, right? Tesla, Alphabet or Google, right? NVIDIA, Microsoft, Amazon, and Apple, right? Those are the seven. And when we look at some of the headlines, this was just from July 10th. NVIDIA is the first to $4 trillion. So that's the market cap of that. If you look at the right-hand side, it shows you where Microsoft is, Apple, Amazon, Alphabet, Meta, right? So it really represents the fact that we had the first company to 4 trillion, which is mind-boggling, just the size of the number. They're a chip maker. They're obviously benefiting from this AI boom, building out data centers and focusing on some of the crypto mining, things of that nature, and gaming clearly. So that's a pretty staggering headline. I remember when I believe it was Apple. I think Apple was the first to a trillion, and so now the question is who's going to be the first to 10 trillion, and is that number actually feasible? Is that doable? When we get into looking some of the performance, there's a lot of noise here. But essentially, if we look at some of these periods of time, you can see, like in this chart here, Magnificent Seven, had some really great years. In 21, it was up 40. In 22, it was down 40. In 23, it was up 76. In 24, it was up 40, 48. Year to date, the returns haven't been quite as strong. But this became a very popular trade, and there's still a lot of these companies are driving a lot of the revenues. But I do want to share with you just some of the things that we want to be concerned with. and just be mindful with, because we're big believers of broad diversification. And so if we just look through the end of March, this was right at when we were having the correction in the markets. The S&P, if you excluded the Mag 7, was up 1%, but the Mag 7 was down 15, right? So that shows you the magnitude of having 7 companies be so large. The thing that really, this is a really important slide. It basically shows, we know at the end of the day, earnings of a company, profits of a company are the best predictor of long-term stock performance. And so when we look at this, we say, okay, well, how much of the global earnings or global profits do the Magnificent Seven drive? And the short answer, you can see on here, is 11%. But when you look at the value in the company, they are 20% of the global market cap. And so that to me looks like a disconnect, right? Because theoretically, over time, your global earnings and your percentage of global earnings should be very similar to your global market cap. Now, you could argue that people are investing anticipating that the global earnings percentage is going to grow, which is a fair argument. But that's a pretty big gap, being at 11 versus 20. And so that's why, while we do like a lot of the companies there, our expectations are some of the returns are probably going to be smaller on a go-forward basis. Because of how big they are. And in fact, that's what this chart shows. So if we made the assumption that these companies were going to grow at these astronomical rates, and we look at, well, what if they could just keep growing at 25% a year? And the rest of the global equity markets, in combination, grow at only 8%. Basically in 5 years, they would go from 19% of the overall economy now, or overall markets. Now we're talking about 7 companies. They would go from 19 to 33. By 10 years, that means that 7 companies would represent 51%, and in 15 years, it would be 68%. Now, you can see off on the right, it says that means that at that stage, 7 companies would hold 68% of global equity markets, while 8,500 companies with only 32%. I think, is it possible? Of course. Is it likely? I don't think so. And so that's going to be one of, I think, our big challenges here is, while we like some of these big hyperscalers, we like these bigger, larger companies, at some point their growth rates are going to slow. And so it's going to be really important that we don't just rely on past performance, and we're always looking forward to make some of those decisions about what should we trim, how do we make sure we have proper alignment, proper diversification. And that's going to be really important. And sometimes it's easier said than done. Now, with that being said, I do have a little bit of a dot-com bubble history lesson. So if we remember the dot-com bubble, this was leading up to 2020, and we had in 2000, when we had a technology crash in 2000. And so there's a lot of companies listed here. So this shows on the left-hand side, the top contributors, what was the rates of return in 1999. Microsoft made 68%. Cisco made 131%. Oracle, 290%. Qualcomm, 2,600%. Sun Micro, 260, Yahoo, 265%, right? You just keep going down this list. Now, that was a really crazy time in technology. So then when we said, okay, well, if I looked ahead, how did the markets do? So over the next 5 years, the stock market, the S&P 500 averaged down 2%. All of these other company returns that are listed on the left were negative and worse than the markets. Over the next 10 years, we had one company, and this looks to me, can't tell if this is Microsoft or it looks like it might even be HP, but we had one company that had positive returns. This S&P still had a slight negative, and then you can see the market outperformed all these positions, and we had one company go bankrupt, which was Lucent Technologies. Then after 25 years, only 2 companies, Microsoft and Oracle, had outperformed the S&P 500, and then the rest underperformed, and then 6 of those 15 no longer exist, which likely they either went out of business or they were bought by competitors. So what's the message here? The message here is that coming out of the dot-com, there was a lot of companies that did extremely well, but when we look back in rearview mirror, because they were so expensive, it was going to be harder to generate higher or above market returns on a go-forward basis. And so I don't know if we're at an inflection point right now for the Mag 7. Clearly, because of AI, there could still be some more runway left to allow these to run. But we have to be mindful of this, that there's a possibility that this could occur. And so that's a really important part of portfolio discipline is the timing and the diversification and making sure that we're making proper decisions to trim some of these companies, especially if we are forecasting that the returns are going to be lower. So I just thought it was a helpful history lesson just going through some of this past data. And then this just shows over this past year some of the divergence in the performance, with Meta driving the best performance at up 26, and Tesla and Apple down towards the bottom at down nearly 20%, and then the S&P coming right in the middle of around 6%. So again, be mindful here, and again, just comes down to not being overly concentrated. Oh, one of the questions that we get a lot, or I see written about, just like, should I just invest in the S&P 500? I look at past performance. It's like, hey, why don't I just invest in the S&P 500? So we're going to unpack that conversation now. So the S&P 500 top 20 holdings represented, basically as of this month, are these 20 companies. You can see their weighting. So for example, I'm going to run through a few of these. NVIDIA represents 7.8%, Microsoft 7%, Apple 5.9%, and then the cumulative weight is just adding them up, right? And so when we get through that whole list of 20 companies, right, the S&P is 500, so automatically we'd say, oh, we're really diversified with 500. When we add up these top 20 and you look at the bottom right, this shows us that you're at a cumulative weight of 46%. So essentially the top 20 holdings are roughly 50% of your allocation. Now, the good news with that is we have a lot of great companies in here that can be owned. But one of the things that we're big believers of is over time we want to have, especially with our larger stock portfolios that are direct investing in a larger basket of stocks, is we want to make sure we have more diversification. So I'm going to give you a little bit of just a history on this. Is if we broke the market into three separate categories. On the far left-hand side, this shows the S&P 500. We already talked about how the top 20 holdings drive 50% of the allocation. But then more importantly, you can see this is a Morningstar style box, large, mid, and small. What we're highlighting here is there's no small cap. Now, over time, if we look back over the last 100 years, smaller cap stocks have outperformed larger cap stocks over a long period of time. That has not been the case for the last 10 to 15 years, though. Large has done better. But we're big believers of when we're diversifying, we want to look at the entire market. And so a better potential index for that is the Russell 3000, right? You can see here, there's still a heavy emphasis on large, but you can see there's small company exposure. If you add up these 3%, 4%, 2%, there's roughly 9% in small exposure. And then a big core part of the portfolio is using the DFA Core Equity 2 ETF. I'm not recommending this per se on this, but just giving this as an example. You can see has some higher small cap exposure, some a little bit higher mid cap, and significantly less large, right? And so it just is, this portfolio is built more to be more broadly based. And so when we look at that, and I'm going to give an example of like what broad diversification looks like, the S&P has been a really hard fund to beat for the last 10, 15 years. But I'll show you there's been some times where the S&P has not been the best index to own, which is why we believe using a broader index is more applicable. So a lot going on here. This concept of winning even when it doesn't feel like it. So this is only updated through the end of 23, not through the end of 24. So we do have a little bit of data that needs to be updated. So we do need to update this, but the concept still makes sense. So we went through a period, I've broken this down into a couple categories, a period where value outperformed, and that was 2000 to 2008, a period where growth outperformed, and then looking at the total return through a full market cycle of 24 years. So when we start thinking about diversification, let's just look, I'm going to give you some examples here. In 2000 versus to 2002, so for 3 years, the S&P lost 40, a diversified portfolio of equity lost 19. In 2003 to 2007, so sorry, the emotion is I lost money, right? The S&P lost 40, I lost 19. Neither scenario is good. Clearly, the diversified portfolio did a little bit better, but you still lost money. Then we went through a 5-year period where diversification worked. The diversified portfolio, which has U.S., large, mid, small, international, emerging markets, did better. And then in 2008, the more diversified portfolio, I lost more money, right? And so through that cycle, though, a $100,000 invested in the S&P was worth around $70,000, and invested in diversified was around $117,000. So obviously, this shows the case for why diversification can really work. The reality is, when we look at the rearview mirror, which is the last essentially 14 years. Through almost every little cycle that I went through, 2009 to 19, Q1 of 2020, which was the start of COVID, through COVID, through the last couple of years, the whole emotional feeling is I didn't make as much, I lost money, I didn't make as much, I lost money, I didn't make as much, right? And even though like 2009 to 2019, the S&P made 351, a diversified portfolio made 317, still really good, but it still didn't make as much. So if you're tracking against that benchmark. And so when we look at that 100,000, you can see grew to quite a bit more in the S&P than it did in a diversified portfolio. So many investors are using that lens of saying, well, why shouldn't I just invest in the S&P? Because clearly this data would show me, especially when I just look at the last 15 years. Now, when I take into account this whole 24, 25-year period, now you can see that the more diversified portfolio did better over a long period of time, and that's why we put the note there. It wins even when it feels like it's losing. And so I'll add the 2024 data. It does improve some of the S&P returns, but this is just a reminder that we have these long-term cycles that can essentially go against you for a period of time. We've been living through a growth outperformance, but that's not going to happen forever. And again, diversification is what matters. Portfolio rebalancing is what matters, is bringing things back into alignment over time. The next concept we're going to discuss is market volatility. So we see these big spikes of volatility. Volatility is measured by something called VIX. So it's basically measures volatility in the market. We had these big high periods of 2008 during the financial crisis, 2020 during COVID, and then during the tariffs, right? So this tariff spike was something bigger than we had seen since the 1990s, only two other periods. So it shows you the kind of fear that was out there. Now the VIX is pretty low because things have normalized, but these periods of time cause a ton of emotion, and they can be very dangerous for investors because in hindsight, these proved to be very good entry points, good times to invest when the volatility spiked. Kind of a noisy chart. Let me just highlight, we highlighted a bunch of things like the stagflation of the 1970s, the Volcker tightening, which is the Fed chair in the 80s, Black Monday in the 80s, the tech bubble, the global financial crisis, the pandemic, right? We highlighted all of these. So the thing that is really important is this box, right? We have the average bull market is 70 months up, which is, north of 5 years. The average return during that period is up 221%. Bear markets average about 14 months, which is an average return of down 38, right? So these ups and downs in the market can be pretty severe. And so the really important message when it comes to volatility is part of investing. If you can't handle volatility, we really shouldn't be a long-term equity investor because it's coming. It's going to come every year, and it's unavoidable. Even through diversification, we're still going to see that volatility because this is the S&P, and these little red dots throughout here show like what was the largest intra-year decline during for a year. So you look here, this goes back to 1980, 45-year cycle. This year says YTD, a good example. The markets through the end of June were up 5%, but during the year we had a 19% loss. So when we look at periods of time, even like I love referencing COVID because COVID was an example of the market at one point was down, you can see here, down 34%, but the year it finished up 16. So being a long-term investor is really important because this type of volatility is really normal. It's scary when you're in the middle of it, but it is normal. And the average intra-year drop through this 45 years is 14%, but the annual returns were positive 34 of the 45 years, right? So odds are that these long-term trends are in your favor, and you have to just kind of drown out the noise when it comes to volatility and get rid of the fear and be a much more pragmatic, long-term thinking investor. Along those lines, we're going to just dig into this whole concept of rewarding investor discipline. What does that then mean? So when we talk about volatility, an intra-year decline of 10% is not uncommon, right? So when we go back, this is a 98-year chart. Greater than a 10% decline happened 57% of the time. So that means if you're an investor, you should be expecting that, let's call it 60% of the time during the year, you're going to have a 10% decline. Then the reality is, what about a 20% decline? Well, that happened 30% of the time. So that means, roughly 1 in 3 years. And then what about a greater than a 30% decline? That only happened 10% of the time. So that's 1 of every 10 years. So that's what we have to prepare for as investors. one of every 2 years, we're going to expect a 10% decline. One in every 3 years, a 20% decline, and one of every 10 years, a 30% decline. That's historic data, but that is normal. That is very common. And again, part of just being a good investor is we have to embrace that. The other concept is this idea, don't be scared out of the market, right? So when we go through this correction period where the market's lost 16%, well, how did a diversified portfolio do against cash, right? Because most people, if you get scared, where do you go? You go to cash. So this is representing a little bit over a 40-year window that shows, 1 month after the correction, 3 months, 6 months, and 12 months. 12 months is, you're 13% better off than cash. And so again, historical performance is not going to drive, it does not necessarily mean that's what's going to happen in the future, but it's just a reminder of, why it's important not to get scared out of investing. That's why we spend so much time building a financial plan and we make investment decisions around a plan, is that if your plan is intact, if your plan is in place, we've prepared for these declines because we know they're coming. We don't know when they're going to come, but we know when, or we know that they will come at some point. So that's why we build your financial plan with a diversified strategy so that we can weather this volatility and help you avoid being scared out of the market. And when we get into this, is just some more data that just shows the total return. I'll just focus on this first one here after a 10% decline. I guess we technically almost had a 20% decline, so let's focus there. 1 year later, historically, again, this goes back we're at 98 years of data. The average return is up 21%, on a 3-year average is up 42, and on a 5-year average is up 75. So when we have these 20% corrections, that is, at least in the past, showed us this is a good roadmap for decently positive returns, subsequent or just after these downturns. So we're wrapping it up. So I think many of you know we're a growing firm. We've expanded. We have over 20 employees. We've expanded to Costa Mesa. We've built out a pretty solid 10-year plan to continue to serve more clients, to build a strong team, to really cultivate that next generation of advisors. So really proud that we have an amazing leadership team, an amazing company, and amazing clients, right? And so just wanted to thank you for all your years and dedication and support to what we're trying to accomplish. One of the things that we always want to make ourselves available, especially when you have times of volatility, is that, if you have family or friends that you think could benefit from meeting with us, send them our way. You don't need to pre-screen them. If they need some help, we'll do our best to serve them. And if we can't help them, we'll get them to the right place. And so just know that we're building our company to be able to accommodate growth, which again means being able to help more people. And so with that in mind, if you're already a Vance Wealth client, we understand, you understand we're monitoring the markets, the tax laws and interest rates. As we get towards the end of the year, we will be having year-end planning meetings. Most of them start in September and run through November. If there's some things that are popping up on your mind that you want to meet sooner, please let us know. Otherwise, your team will be reaching out. If you're new to Vance Wealth and you're just uncertain about what's happening with your tax strategy, your investment approach, or you just want a second opinion, we'll do a complimentary consultation. So please just reach out so that we can, we'll want to gather some documents, ask you some questions, and then we'll be able to give you a report that does a deep dive on your investments and your plan and give you some guidance, and maybe would be a good fit to help you on a go-forward basis. You can reach us, you can schedule an appointment, just go to vancewealth.com. And you can schedule an appointment there, or you can call the office at 661-775-0950. Thank you very much. I hope you found our 2025 mid-year economic and market update valuable. Again, please like and subscribe on the YouTube channel, and we're looking forward to reconnecting in the future on our next video. Thanks.